You know, I've read thousands of books in my life, literally thousands. I read 5, 6 hours a day, even now at 94 years old. And people ask me all the time, Warren, what's the most important book you've ever read? And I always give them the same answer without hesitation: The Intelligent Investor by Benjamin Graham. That book that book changed my life. It shaped how I think about money, about investing, about building wealth. It's the foundation of everything I've done. I first read it when I was 19 years old. I was a student at Columbia University, and Ben Graham himself was my professor. And when I read that book, it was like scales falling from my eyes. Suddenly, investing made sense. Suddenly, I understood how the stock market really worked. That book made me rich. Not directly, of course. The book didn't hand me money, but it gave me the principles, the framework, the philosophy that allowed me to build wealth. And today, I want to share those principles with you. Because here's the truth: if you understand and apply what's in The Intelligent Investor, you can become a millionaire. Not might become, can become. The path is clear. The principles work. They've worked for me for 70-some years, and they'll work for you too. So let me take you through the key lessons from this book, the lessons that made me rich, and more importantly, how you can use them to reach your first $1,000,000. Let's start with the most fundamental concept in the entire book, the concept that Graham spent more time on than anything else. And that's the difference between investing and speculation. Most people think these are the same thing. They use the words interchangeably, but they're not the same. They're completely different. And understanding this difference is the first step to building real wealth. Here's how Graham defined it. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. Let me break that down. An investment has three characteristics. First, you've done thorough analysis. You understand what you're buying. You know the business, the industry, the financials. You've done your homework. Second, safety of principal. You're not likely to lose your money. You're buying something at a price where, even if things don't go perfectly, you're probably going to be okay. And third, an adequate return. Not a spectacular return, not a home run, just adequate, reasonable, enough to justify the investment. Everything else is speculation. If you're buying something because you think the price will go up, but you haven't analyzed it thoroughly, that's speculation. If you're buying something at a price where you could lose most of your money, that's speculation. And here's the key: there's nothing wrong with speculation. Graham himself speculated sometimes. But you have to know which one you're doing. You have to be honest with yourself. The problem is, most people speculate while thinking they're investing. They buy stocks they don't understand at prices that don't make sense, hoping to get rich quick. And then they're shocked when they lose money. When I started investing, I followed Graham's approach religiously. I only bought things I understood. I only bought at prices that offered safety of principal. I aimed for adequate returns, not spectacular ones. And you know what happened? Over decades, those adequate returns compounded into spectacular wealth. Because I wasn't losing money on bad speculations, I was steadily, consistently building wealth through real investments. So that's lesson one from The Intelligent Investor. Know the difference between investing and speculation. Be an investor, not a speculator. That's the foundation. The second major lesson from the book is the concept of Mr. Market. This is one of Graham's most brilliant insights. And if you really understand this, you'll never panic during a market crash again. Graham said to imagine the stock market as a person. Let's call him Mr. Market. And every day, Mr. Market shows up at your door with an offer to buy your shares or sell you his shares. Some days, Mr. Market is optimistic and euphoric. He offers you very high prices. Other days, he's depressed and pessimistic. He offers you very low prices. And the key insight is this: Mr. Market is psychotic. He's irrational.
How the stock market really worked.
His prices don't reflect reality.
Of course,
they
the
reflect
book didn't
his
hand me money,
emotions.
but it gave me the principles.
So what
the
should you
framework,
do?
The philosophy that allowed
You should
me to build
ignore
wealth.
Mr.
And today, I
Market's
want to share those
mood.
principles with you
You
because
should
here's the
focus
truth.
on the
If you
actual
understand
value
and
of
apply
what
what's in the
you
intelligent
own,
investor,
and you
you
should
can become a
only
millionaire.
transact
That
with
might
Mr.
become, can
Market
become.
when
The
it
path is
benefits
clear.
you.
The principles work.
When
They've
Mr.
worked for
Market
me for
is
70-some
euphoric
years, and
and
they'll work for
offers
you,
you
too.
absurdly high
So-
prices for your stocks, consider selling. When he's depressed and offers absurdly low prices, consider buying. But most of the time, just ignore him. Let him stand at your door making crazy offers, and don't let his mood affect you. This concept saved me during every market crash I've lived through, and I've lived through a lot of them. In 1973 and 1974, the market dropped almost 50%. People were panicking. Mr. Market was severely depressed. But I understood that Mr. Market's depression didn't mean the businesses I owned had become worthless. Coca-Cola was still selling billions of dollars of soda. The Washington Post was still publishing newspapers. These were real businesses with real value. Mr. Market was offering me absurdly low prices. So instead of panicking and selling like everyone else, I bought more. I took advantage of Mr. Market's depression. And when he became optimistic again, which he always does, those investments became incredibly valuable. Same thing in 2008 during the financial crisis. Mr. Market was having a complete meltdown, offering crazy low prices for everything, and I bought billions of dollars worth of investments because I understood that Mr. Market's mood was temporary, but the value of good businesses was permanent. Most investors get this backwards. They get excited when Mr. Market is euphoric, when prices are high, and scared when he's depressed, when prices are low. They buy high and sell low, and they lose money. But if you understand the Mr. Market concept, you do the opposite. You get excited when prices are low. You get cautious when prices are high. You buy low and sell high, and you make money. That's lesson 2. Understand Mr. Market. Don't let his mood swings affect you. Use them to your advantage. The third crucial lesson from The Intelligent Investor is the concept of margin of safety. This might be the most important concept in the entire book. Graham called it the central concept of investment. Here's what margin of safety means. You should only buy something when the price is significantly below what it's actually worth. That gap between price and value, that's your margin of safety. Let me give you an example. Let's say you analyze a business and determine it's worth $50 a share. Should you buy it at $50? No, because your analysis might be wrong. You might have made a mistake. The business might not be worth as much as you think. But what if you can buy it at $35? Now you have a margin of safety. Even if your analysis is off by 20%, you're probably okay. You're buying at such a discount that you're protected against errors in judgment. This is how you avoid losing money, not by being perfect in your analysis, nobody's perfect, but by only buying when there's a big enough margin of safety to protect you when you're wrong. I've followed this principle my entire career. I won't buy something at a fair price. I'll only buy at a good price, a price that offers protection, a price where even if I'm somewhat wrong about the value, I'll probably be fine. And you know what? This approach means I miss a lot of opportunities. There have been great companies that I didn't buy because the price never offered a sufficient margin of safety, and some of them went on to do very well. But that's okay, because the investments I did make, the ones with a margin of safety, those have worked out extremely well, and more importantly, I haven't lost much money, because the margin of safety protected me when I made mistakes. Graham said it perfectly. The margin of safety is always dependent on the price paid. It will be large at one price, small at another price, and non-existent at some still higher price. This is why I don't buy expensive stocks, even if they're good companies. If I pay too much, there's no margin of safety. I'm vulnerable to even small mistakes in my analysis. So that's lesson 3. Always insist on a margin of safety. Buy things below their value, not at their value. That gap protects you and ensures you make money over time. Now, the 4th major lesson from the book, and this one's practical, is the formula for dollar cost averaging and long-term investing. Graham recommended a simple approach for most investors. Invest a fixed amount regularly into a diversified portfolio of stocks and bonds. Rebalance periodically, hold for the long term. That's it. That's the whole strategy. This is what we now call dollar cost averaging. You invest the same amount every month, regardless of whether the market is up or down. When prices are high, your fixed investment buys fewer shares. When prices are low, it buys more shares. Over time, this averages out your cost per share. You're not trying to time the market. You're not trying to be clever. You're just consistently investing month after month, year after year. For most people, this is the smartest approach. Not because it maximizes returns, it doesn't, but because it's simple, it's consistent, and it works. You're almost guaranteed to build wealth this way if you do it long enough. Let me give you some numbers. Let's say you invest $500 a month in an S&P 500 index fund. That's $6,000 a year. Not a huge amount, but consistent. Over 30 years at a 10% average annual return. You'd have about $1 million. You invested $180,000 of your own money, and compound interest turned it into $1 million. That's the power of consistent long-term investing. You don't need to be clever. You don't need to pick winning stocks. You just need to invest consistently and give compound interest time to work. Graham understood this. He said that for most people, trying to beat the market isn't worth the effort. Just invest in a diversified portfolio, add to it regularly, and be patient. That's the path to wealth. Now, I've done better than that because I've focused on individual stock picking. But that's because I've devoted my life to studying businesses. For most people who have jobs and lives outside of investing, Graham's formula is smarter. That's lesson 4. Invest regularly, diversify, hold long-term. Simple, but incredibly powerful. The 5th lesson from The Intelligent Investor is about temperament. Graham said that investing is not about intellect, it's about temperament. You need the temperament to avoid panic when things go wrong and greed when things go well. This is so important. I've known incredibly smart people who failed at investing because they had the wrong temperament. They panicked during crashes. They got greedy during booms. They let emotions drive their decisions. And I've known people who weren't particularly brilliant, but they had the right temperament. They stayed calm, they stuck to their principles. They didn't let fear or greed override their judgment, and they became wealthy. So what is the right temperament? First, you need patience. Real wealth takes time, decades usually. You can't be in a hurry. You can't expect quick results. You have to be willing to wait. Second, you need discipline. You need to follow your investment principles even when it's uncomfortable, even when everyone else is doing something different, even when you're tempted to chase hot stocks or sell in a panic. Third, you need emotional control. You can't let the market's gyrations affect your mood. When stocks go down, you shouldn't feel devastated. When they go up, you shouldn't feel euphoric. You should stay even-keeled, rational, calm. Graham emphasized this repeatedly. He said the investor's chief problem, and even his worst enemy, is likely to be himself. Your emotions will try to sabotage you. Your fear will tell you to sell at the worst time. Your greed will tell you to buy at the worst time. You have to resist these impulses. You have to have the temperament to ignore your emotions and stick to sound principles. That's what separates successful investors from unsuccessful ones. I learned this early from Graham, and it served me my entire career. During every market crash, while everyone else was panicking, I stayed calm. I reminded myself of Graham's principles. I focused on value, not price. I bought when others were selling. That temperament, that emotional discipline, has been worth billions to me. Not because I'm smarter than other people, but because I can control my emotions better, because Graham taught me how. That's lesson 5. Develop the right temperament. Be patient, disciplined, and emotionally stable. That matters more than intelligence. The 6th lesson from the book, and this one's often overlooked, is the importance of reading financial statements. Graham said an intelligent investor must understand the basics of financial analysis. You don't need to be an accountant, but you need to be able to read a balance sheet, an income statement, and a cash flow statement. You need to understand basic metrics like price-to-earnings ratios, debt-to-equity ratios, return on equity. Why? Because this is how you do thorough analysis. This is how you determine whether something is a good investment or not. You can't just buy based on gut feeling or tips from friends. You need to look at the numbers. When I was young, I spent countless hours learning to read financial statements. I'd get annual reports from companies and go through them line by line. I'd calculate ratios. I'd compare companies in the same industry. I'd look for businesses that were undervalued. This skill has been fundamental to my success because I can look at a company's financials and understand what's really going on. I can see if they're profitable, if they're growing, if they're financially stable, if they're priced reasonably. Most people skip this step. They buy stocks based on headlines or recommendations or whatever's popular. They have no idea what the underlying business is actually worth, and that's why they lose money. Graham taught me to always do the analysis, always look at the numbers, always understand what you're buying. Never invest in something you haven't thoroughly analyzed. Now, I'll admit, for people who just want to invest in index funds, you don't need this skill. The index does the diversification for you. But if you ever want to pick individual stocks, if you want to find undervalued opportunities, you absolutely need to learn financial analysis. That's Lesson 6. Learn to read financial statements. Understand the numbers. Do thorough analysis before investing. The 7th lesson is about the dangers of following the crowd. Graham warned repeatedly about the tendency of investors to follow popular opinion instead of thinking independently. Each time people thought I was crazy, the crowd disagreed with me, but I wasn't following the crowd, I was following Graham's principles, and those principles proved correct every time. That's Lesson 7. Don't follow the crowd. Think independently. Be willing to be contrarian when the analysis supports it. The 8th lesson from The Intelligent Investor is the importance of diversification. Graham said diversification is an established tenet of conservative investment. He recommended that most investors own at least 10 to 30 different stocks across different industries. Why? Because even with thorough analysis, you can be wrong. Even good investors make mistakes. Diversification protects you against those mistakes. If you own one stock and it fails, you've lost everything. If you own 30 stocks and one fails, you've lost about 3%. That's the power of diversification. It reduces your risk without significantly reducing your returns. Now, I'll be honest, I've been more concentrated than Graham recommended. I've often had large positions in just a few companies. But that's because I've devoted my entire life to analyzing businesses. I've had the time and expertise to have high conviction. For most investors, that's not realistic. If you have a job, a family, a life outside of investing, you can't devote 40 hours a week to analyzing companies. So you need more diversification to protect against mistakes. The easiest way to diversify? Index funds. An S&P 500 index fund gives you ownership in 500 companies across all major industries. You're instantly diversified. You're protected against any single company failing. Graham would have loved index funds if they existed in his day. They perfectly implement his recommendation of broad diversification with minimal effort. That's Lesson 8. Diversify your investments. Don't put all your eggs in one basket. Protect yourself against mistakes. The ninth lesson is about avoiding debt and maintaining financial conservatism. Graham was very conservative about debt. He believed companies should have strong balance sheets with manageable debt levels. And he believed investors should avoid margin debt, borrowing money to buy stocks. He said margin magnifies your gains when things go well, but it also magnifies your losses and can wipe you out when things go badly. I followed this principle strictly. I've never used margin to invest, never borrowed money to buy stocks. And I've preferred companies with little or no debt, companies that can weather any storm because they're financially strong. This conservatism has protected me during every crisis. When markets crash, companies with too much debt often go bankrupt. But companies with strong balance sheets survive and thrive. They can buy assets cheaply from desperate competitors. They emerge stronger. The same applies to personal finance. If you're in debt, if you're financially overextended, you can't take advantage of opportunities. You're vulnerable to any setback. But if you're debt-free, if you have savings, you have options, you have flexibility. That's lesson 9. Be financially conservative, avoid debt, maintain strong financial foundations. This protects you and positions you to capitalize on opportunities. And finally, the 10th lesson from the intelligent investor is the most important one of all. It's the lesson that ties everything together, and it's this. The goal of investing is not to beat the market, it's to build wealth steadily and safely over time. Graham said the defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. He wasn't trying to find the next big winner. He wasn't trying to maximize returns. He was trying to make adequate returns with minimal risk, to build wealth steadily without losing money. And you know what? That approach works better than trying to beat the market. Because when you try to beat the market, you take more risks, you make more mistakes, you lose money on bad bets, and those losses compound over time. But when you focus on steady, safe returns, what Graham called adequate returns, you avoid big losses. You keep compounding. And over decades, those adequate returns become spectacular wealth. I've never tried to beat the market every year. Some years I do better, some years I do worse. But over my entire career, I focused on consistent, steady returns with minimal risk, and that's led to extraordinary wealth. That's the final lesson. Don't try to get rich quick. Don't try to beat the market. Just focus on building wealth steadily, safely, over time. That's the path to $1 million and beyond. So there you have it. The 10 key lessons from The Intelligent Investor. The book that made me rich. The principles I've followed for over 70 years. Let me recap them quickly. 1. Know the difference between investing and speculation. Be an investor. 2. Understand Mr. Market. Use his mood swings to your advantage. 3. Always insist on a margin of safety. Buy below value, not at value. 4. Invest regularly, diversify, hold long term. Simple but powerful. 5. Develop the right temperament, patience, discipline, emotional control. 6. Learn to read financial statements. Do thorough analysis. 7. Don't follow the crowd. Think independently. Be contrarian when appropriate. 8. Diversify your investments. Protect against mistakes. 9. Be financially conservative. Avoid debt. Maintain strong foundations. 10. Focus on steady, safe returns. Not beating the market, but building wealth. If you follow these 10 principles, you will build wealth. Not overnight, not in a year, but over time, steadily, safely, you'll reach $1 million and then more. These principles work. They've worked for me. They've worked for thousands of other successful investors. They'll work for you if you apply them. But here's the key. You have to actually apply them. Reading about them isn't enough. Understanding them isn't enough. You have to live them. You have to make them part of how you think about money. So here's what I want you to do. First, get a copy of The Intelligent Investor. Read it, not quickly, but slowly. Take notes. Think about each principle. Let it sink in. Second, start applying the principles. Open an investment account if you don't have one. Start dollar cost averaging into index funds. Start building that margin of safety. Start developing the right temperament. Third, be patient. This is a lifelong journey. You're not going to be a millionaire next month or next year. But if you follow these principles consistently for 10, 20, 30 years, you'll get there. I promise you that. Because the math works, because the principles work, because compound interest works, you just have to give it time. The Intelligent Investor changed my life. It can change yours too. Not because it's magic, but because it teaches timeless principles of wealth building that anyone can learn and apply. So get the book, read it, apply it, and start your journey to $1 million using the same principles that made me one of the richest people in the world. Thank you for listening. Now go become an intelligent investor. Good luck.